Henry, let's try to put this in context. You have visited China frequently. You and I have talked about China often. Our focus is mostly on trade, and we'll get to the substance of this Bloomberg Business Week investigation. Which camp do you fall into? The one that says the U.S. and China are waging a trade war, or the one that doesn't?
We're in the camp that this is a new era between the China and U.S. relations. I think we had talked about this before, and I think that the dominoes have kind of, fallen in favor of our worldview. So let's talk about the short term and then get to the long term. Short term, what I think many investors are missing is that when you look, actually, the trade tensions are actually increasing economic activity. We were just recently in Shanghai and Beijing. Companies are pre-ordering ahead of the tariffs. We see the same thing in the U.S. When you look at...
They want to get in before the bell.
Yeah, so if you look at third quarter GDP estimates for the U.S., it's about 4%. Half of that is actually inventory builds, which I think, I'm not sure why that's not being picked up, but that's what's happening, where a lot of people are trying to buy ahead of the Christmas season at the lower prices. So that's kind of the near term. The second is on the inflation. I think you have to separate the world between industrial companies and consumer companies. Industrial companies, and this is not just a China-specific comment, but anybody with steel or other types of input costs, they are passing through those costs very easily, 10 to 15 to 20%.
They have pricing power.
They definitely have pricing power. Not happening on the consumer side. Importantly, though, you won't really see the consumer businesses face this input cost pressure until, I think, the first quarter of 19. I think you'll hear some of it about in the fourth quarter, but really, you have to remember that the $200 billion just went into effect, and the $250 billion that comes into effect, that's much more consumer-dominated products than the first leg of the tariffs.
So let's add it up if we can. We've had one round of 50, another round of 200, another round of 250 coming.
Maybe coming, yes.
Threatened. But what kind of a risk does that pose to the U.S. economy in terms of growth on the one hand and in terms of inflation on the other?
It's all about confidence. Our work at KKR would show that if you put all the tariffs into place, including autos, you get somewhere between 0.75% to 1% drag on GDP. If you get a 10% pullback in business confidence that affects fixed investment, that's a 1% decline in GDP. So 2
percentage points then, possibly.
Well, to me, it's really about confidence. What I think the Trump administration did that has worked in their favor is they, just hear me out, is they actually cut taxes and then did the fiscal stimulus, and then they focused on the trade tensions. China is easing very aggressively right now, but that's in response to the trade tension. So there's a very different feel what you get on the ground right now. The central bank and the government are easing in China, but they're now doing it after some of the tariffs have been imparted on their kind of economic food chain.
So here, to draw an analogy, we foam the runway, and there they've brought out the fire trucks to douse the burning airplane.
Yeah, but make no mistake. I mean, to me, they're doing the equivalent of a TARP in the fixed income markets right now, which are improving credit cost. They are cutting taxes for consumers, and if you look at the currency, the currency's moved down, kind of 8 to 10%, which is quite an elixir in terms of exports.
There's a widespread belief, Henry, that if the Chinese just respond to these tariffs and buy more American goods and correct the imbalance, these tensions are going to go away. And that's not true, is it?
That's not true. I think that the U.S. government's made it very clear this is not about reducing the trade deficit by buying more goods. I think that makes good headlines. That's not the story. This is about two things in my mind. One is about a change in supply chains related to intellectual property. And I think that we are seeing countries like Vietnam really become big beneficiaries as things move out of China. And then the second, it's really about national security and about technology. You guys broke a very interesting story this morning. That, in my mind, is where the U.S. government is focused. And if you think about it, the U.S. government or the U.S., there's a separation of church and state between private sector, technology, and the government. In China, I think the U.S. would say that's less clear. Because
meaning what? That Baidu and Tencent and Alibaba are effectively agents of the Chinese government, or is that taking it too far?
That's not our view, but that's somewhat of the accusation that's been put on the Chinese companies. Look, China has an incredible, I'd say, close to an empire in technology right now on the consumer side. I mean, if you look at what Baidu and Tencent and Alibaba are doing to that economy. They are helping to transform at an accelerated pace this rise in GDP per capita. With that comes a lot of power and a lot of information, and I think that makes the U.S. Nervous.
Does the market underestimate the seriousness with which the administration is approaching the threat China poses to intellectual property and national security?
I think the market has gotten, it's taking lots of different inputs. I mean, we have many things going on around the world. We could be talking about Italian bonds or credit contraction in India. The market has gotten one thing right, which is earnings are strong. That's the bottom line. And so this year we'll probably have 20+% earnings growth in the U.S. The multiple has compressed 10 to 15%, but net, the U.S. stock market's going to be up. You don't have that type of earnings growth in the rest of the world, and so that's why you've had this bifurcation in the market performances.
I want to make a pivot to inflation and growth again and talk about rates, but before I do, let's talk about this Bloomberg Business Week investigation for one moment. What we've established, as you know, is that the People's Liberation Army, using a subcontractor, implanted this tiny little microchip on a motherboard that was used in a server. Servers by Apple, Amazon, a major bank, maybe 30 companies in all. Does this, if all of that stuff, and I should add that these companies have denied much of our reporting, but if it's all true as we've reported and we're confident, does it take the tech war, the war over IP, to a new level?
I think it probably does. I mean, to me, though, the tech war had started long ago, because if you think about natural resources, that used to be the area of focus. To me, data and technology is power. And the more that governments and economies can dominate that, it really does become a market of one. And we've seen China be a leader in that with Alibaba and Tencent. We've seen the U.S. with Google and Amazon. Those are really the global titans. And the private, this is an interesting time in our time as market watchers, because the private sector and the public sector, there's a convergence that wasn't there before, and that's something that we'll have to watch unfold.
So let's go back to inflation and rates specifically. On the one hand, I mean, we have a number of different factors at work. We have the Federal Reserve raising rates, and you were very outspoken about the Fed's commitment to raising rates at a time when others were unsure about it. Back early in the year, you proved you were right. And this week, you know, we need look no further than comments by all the Fed officials who've spoken about the fact that they want to raise rates.
And
now, but what I was going to get into is, tariffs, right? So that's raising prices. We've got wage growth accelerating and rising interest rates. What impact is that going to have on companies' ability to earn?
Well, I think the bond market and the stock market are telling you different things, right? The stock market is selling off because it's worried about the Fed and potential inflation. If you look at the bond market, though, what it's telling you right now is 75% of the increase in rates year to date in the long end, the 10-year, where we price mortgages and things like that, that's actually all real yields going up, i.e. the market is saying growth is stronger. Only 25% of the increase in rates has actually come from inflation expectations moving up. So if you're the central bank, you're actually okay with that. It's not, inflation expectations are not getting untethered. I think what I would focus on, and this ties into my comments earlier on trade to kind of bring them together, when we get into 2019, I would make the prediction that we see margin degradation in many companies. So there's going to be a movement. Thus far, a rising tide has lifted all boats. We're going to have a world of kind of what I would say is price makers who can set price and put the costs through, including wages, interest costs, and oil, and those that can't. And that has not been where we are, and that's going to be a change.
How does KKR translate that into money? How do you make money?
Well, look, we're trying to do a good job for our LPs, and I think one area that we're very focused on right now, you guys have reported, we've really expanded our footprint and infrastructure. We are trying to get focused on, as this shift from monetary policy to fiscal, to own more assets that have cash flowing yield up front that are linked to GDP. There's a secular shift away from monetary policy as it ends towards fiscal policy. And there's a very clear investment action, which is get long things that are linked to nominal GDP. We're doing that in our credit business, our infrastructure business, our real estate business, our energy business, and to some degree in private equity. And then on the defense is just make sure you don't get wrong-footed on wages and margins. And so that's where we're focused.